You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to the Investing Matters podcast. Today I have the huge privilege of speaking with John Stepek, author and executive editor of the MoneyWeek magazine. John is an expert, I would say, because I'm reading through my notes here, and he's been publishing for decades now. Families in Business, Shares Magazine, Spears Magazine, Sunday Times, The Spectator, amongst others. He's appeared as an expert commentator on BBC Radio 4's Today programme, BBC Radio Scotland, Newsnight. John, come on. Daily Politics,
Scotland.
Bloomberg. And, you know, you've got the fantastic book, The Skeptical Investor, which I love because as a contrarian, it's like, I was like loving it, mate. Fantastic book. Right. I want to start, John, really, because you went to uni and you finished and graduated at Strathclyde University, degree in psychology.
Yeah.
But your family's in business, and I'm sure they're all going, "Oh, John boy's going to be going into the family business." What was the decision there, and why did you go into business studies, then slip into psychology, and then come out with a psychology degree?
What went wrong? No, I tell you what
right. What went right?
No, I guess I was. So my background was in family business. So my grandfather came over from Poland after the Second World War, which is a very long story, and set up basically an aerial repair business. And so, you know, TVs were just becoming very popular. And over time, it turned into a kind of small electrical retailer, mostly located in the kind of East End of Glasgow. And then my dad basically took that over from him. And so that was always in the background when I was growing up. And I kind of thought to myself, oh, well, you know, should I join the family business when I grow up? But also always wanted to be a writer right from a very, very young age. Now, I didn't always have a burning desire to be a financial writer or even a journalist. I had a lot of kind of skepticism about journalism. You know, I used to read the papers whenever I was a teenager and essentially just find a lot of it quite infuriating, really. So whenever I was deciding to go to uni, I thought, well, what do I want to do? Because I don't want to be an architect. I don't want to be a doctor. So I thought I'll study business studies, because I thought, you know, that will give me an insight into aspects of the business in case I do decide to, you know, join the family business. And then I also took psychology as an optional kind of module. But what I found really was that what I was most interested in was the psychology and the kind of human elements of a business, because you rapidly realize, particularly whenever you're part of a family business, that the interpersonal dynamics are extremely important. And one of the kind of key things, and I mean, it's the same way, you know, kind of normal businesses, but succession is a big breaking point for family businesses in particular. A lot of them fail at that point, and very few of them make it beyond 3 generations, say. So I thought, you know, that's what I found most interesting. And over time, that's what I ended up specialising in at uni. And I must admit, I dropped the vast majority of the business subjects and just stuck with the psychology, which sort of then feeds into why I wrote The Skeptical Investor, which is in large part a psychology book.
Absolutely, yeah. You know, it's because of that while we're speaking now, and we've been blessed with you for X amount of years now. You know, and the thing I was reading as well was that one of your first jobs was good old Teletext. You got into Teletext finance desk, and I remember coming home and looking on, and like 15 minutes delay to the next page, and then page. It's absolutely what a fantastic place to start, John.
Oh, it was superb. I mean, Teletext was a brilliant grounding in just having to interpret the news as it was coming off. So we would get in at because there were 2 shifts. There was a 74 shift and the 96 shift, and so you'd get in for like 7 o'clock, and the RNSs would all be coming off, and you know, you'd maybe have BP's kind of like first quarter results. and you'd have, until 8 o'clock, which is when the market's open, to get these stories up there. And so you'd be sitting there kind of like trying to read, the kind of BP's accounts, in 20 minutes, that you could write and it was a tiny space. We had like 65 words to write up the stories. And so basically, you just put in like,
even smaller than Twitter.
Oh yeah, it was actually, thinking about it, it was probably good practice for Twitter. Now that I think about it, but no, it was great, because it really taught you to focus on how to read a set of accounts very quickly. Like I remember my boss saying, right, start from the back, because that's where all the muck is, and hopefully that's where you'll find a decent story. And it really, it also trained me to always go to the source, because I think that's a really important thing for individual investors as well. If before you make a decision on something, or before you, if you're taking an investment decision seriously, you should always go back to the original source. I mean, journalists will sometimes get things wrong, or they'll have a skewed angle, and everyone in the industry's also got their own agenda, which is normal. That's human. I'm not judging that. It's just the way things are. So it's always better to read the original text yourself and think for yourself about what you think the important aspect is of it. But yeah, it was fantastic working at Teletext. It's a shame in many ways that it was obviously superseded by the internet. But I was there for 2 years before the writing was, it was very much on the wall, because the vast majority of money in that business, and it was a very profitable business, but it all came from the travel pages. And obviously, the internet kind of destroyed that side of things. So, but it was good. It was great while it lasted.
Yeah, well, the travel business got crushed by Lastminutecom, was that sort of era, wasn't it, when they came out? You know what I mean? So when things were going awry with Teletext, towards the end, and it was being superseded, was the family thinking, "Oh, John's coming back to the business"?
No. That was I was always, I'd kind of made my decision by that point. And actually, eventually the family business kind of went bust, which went in the administration, which is that's what often happens with businesses. And it was a shame, but and certainly it was a shame for all the people involved, but by that point I was kind of I was living in London, and I was well away from any thoughts of kind of going back into it.
Okay, so we get to 2005, and you arrive in your first role at MoneyWeek, and you've just gone like that ever since. You're in your 17th year or thereabouts now. So tell us about the first, going in, and what your thoughts were, and what you wanted to do within MoneyWeek when you first arrived, because it's been a fantastic rise since then, culminating in where you guys are now, as as in a much larger group.
Yeah, MoneyWeek was fascinating. It wasn't a title I was familiar with at the point that I went in, but I then realised that my colleague, Merrin Somerset Webb, was the editor. And I had always been a fan of her columns in the Sunday Times, because she wrote for the Sunday Times money section at that point. And I thought, well, okay, well, this is clearly a serious publication with somebody that really knows what they're talking about. And I also enjoyed the fact that at the time it was owned by a chap called Bill Bonner, who's an American writer. And Bill had always taken a kind of contrarian approach to writing, and also he sort of set up one of the first kind of email newsletters that I'd really read in detail. It was a thing called The Daily Reckoning, and the way he wrote about finance was very at the time it was unusual. Now everyone kind of blogs, and everyone has quite a chatty style, and they sometimes will say something a bit controversial or a bit cheeky, but back then that was very fresh feeling, and it kind of made me think, oh right, you're allowed to write like this about money. And you're allowed to have opinions. And that was the great thing about MoneyWeek. So when I went there, my first job was basically to sort out the website and relaunch the daily email Money Morning. And I still write Money Morning kind of most mornings. And that was really just trying to find an opinionated voice that would maybe point to some of the things in the market that seemed to be, not quite as they should be, because obviously it was 2005, and by that point it was already quite clear that debt was a big issue. And so we were quite often just pointing, different kind of things that could go wrong. We were also talking about how commodities were a good thing to invest in at that point, because obviously there was the rise of China. And at that point, it still seemed like quite a niche investment area. So we focused a lot on that. And of course, so, kind of went along for a few years, and it was, it was kind of, it was good. It was a rapid learning curve, because I got on top of it. You could cover everything, macro, small companies, bonds, everything. And of course, then 2007 came along in Northern Rock. And just as all that was happening, I ended up becoming the deputy editor of the magazine. So that was obviously it was quite an exciting time to be taking over, kind of running the day-to-day of the mag. And I just remember we were in a good place because we had been bearish, and we had been talking about, look, the kind of level of debt in the global economy, something is going to snap. And then obviously Northern Rock came along in the middle of 2007. And I think I'm at the problem now. I'm at the age now where obviously I've got new journalists coming in who are in their 20s, and I think that there is already a younger generation that doesn't get how shocking that was at the time. Like seeing queues outside a bank in the UK, a run on a bank like in Mary Poppins, was just incredible. And it was also incredible that it then took a whole year before people woke up to the fact that actually this was a much bigger problem. The credit crunch, I think people, this isn't emphasized enough. The credit crunch started in the middle of 2007, and the stock market didn't peak until the middle of 2008. And then Lehman came along and kind of, blew up, and that made everyone realize, oh my goodness, this is a big deal. But it'd been going on for about the best part of 12 months to 18 months. So I think that's going to
be this is one of my questions, John, and I'll bring it in now and interrupt you, unfortunately. This is what I'm saying, right? So it starts in 2007. I'm going to talk, because I was going to be that, you're in there at 2005, you're there, you get promoted. It's 2007 and things start to go pear-shaped. You're seeing all these things going wrong. You're seeing the signs. You're writing about it. You're showing all these investors out there and fund managers that read your magazine, because they clearly did, and they were doing at that time as well, and still do. We're seeing all these warning signs. This is for MoneyWeek. We're seeing all these you and Mary and all the other teams saying, watch out, and everyone's going, go away. We're not listening. Why do people, and psychology again, ignore the signs, and they're always bullish until the very last minute, John?
Honestly, it's because people don't want to. Well, it's two things. I think the industry obviously has a bullish bias, because I do remember we had regular roundtables, so monthly kind of chats with fund managers that we'd put in the magazine. And I do remember that all the fund managers at that point were clearly very uncomfortable. They were clearly worried. But it's almost like, well, what are you going to do? If you're an equity income fund manager, you can't just say, actually, I'm really scared. I'm going to sell all my stocks and sit in cash, because, you've got a remit to follow. It's kind of, so I think it's very difficult for people in the industry to escape the fact that their job is to buy stocks, basically, and hold on to them. So I think there's that. So there's the industry side. As for individuals, I mean, this is where I think individuals have a bit of an advantage over professionals, or it's the advantage that they have, is that they don't actually have any kind of portfolio remit beyond make sure your money grows, and they also don't have any external pressure in terms of a boss saying, you have to turn around this quarter, you have to make X%. But the problem is that it's very hard to escape that the momentum, because it's a bit like today, growth did so well for so long, and deflation for so long has been the big threat, that people simply cannot adjust to the idea that it's all going to be the other way around, because what has worked for so long, and we just have a tendency to keep extrapolating. And then when the turning points come, all of the things that you've relied on become useless, basically, because nobody really knows what an inflationary environment's going to be like. And also, I mean, in 2008, the idea that banks would go bust was unthinkable. Most people hadn't seen a major bank kind of like pop its clogs since, at least the 1980s. So I think that's the other thing. There's a lack of memory that these things have happened before. And then we go into it as if it's something completely fresh. So I think that's it. It's very difficult to turn course after being on it for so long.
Absolutely. And people have difficulty with it, and they try to just focus on where things were going well and forget about the bad times, psychology wise. So I want to talk about the latter part of 2008 still, and when things were looking better. There's been that capitulation point there, John, right? And nobody else wanted to go back into the market, and the market started to go like this a little bit, and everyone's going, no, it's complete denial that it was going to happen in the first place. And the second denial was it's not going to bounce back, it's not going to come back so quickly. And then gradually it didn't. What was about 2009 before everyone started 2009, to go, actually we can start being positive again.
Yeah, and I mean I was the same from that point of view. And I learned a lot from 2008 because I went into it thinking this is. I remember it was. I shared this with a lot of the kind of people who had the kind of slightly Austrian libertarian view on things at that point, where it was like, this is going to be a cleansing fire that will purge the world of central bank fiat money kind of corruption and all that. And I was too bearish for too long. I failed to recognize that in March 2009. I mean, actually, weirdly enough, I actually remember writing a letter in March 2009 saying that I was buying stocks I actually did go into the market at that point. But I didn't think that we were going to get the rebound that we did. Whereas obviously in retrospect, that's the point at which central banks got ahead of it. They just said, we're going to print all this money. At that point, we hadn't seen anything like that. And again, I made the mistake of thinking that was going to be hugely inflationary. And it wasn't, for reasons which one of my kind of favourite kind of writers, James Ferguson, had already pointed out. He was saying, well, look, we're in a bank bust. And when banks are bust, the monetary transmission mechanism stops working. And the only way we're going to get back to something approaching normal is once the bank balance sheets are fixed. And that always takes a long time. And again, because James knew his history, and he'd looked back at all of the previous, because there'd been a big bank collapse in the Scandinavian countries in the early 1990s. And he sort of did a chart of, about 7 or 8 of these things. And they always took an average of kind of 5 to 10 years before, things got back to normal. So weirdly enough, the situation we were in before the pandemic, that was actually what you typically get after a banking crisis. You get a big deflationary bust and it takes ages before they get back to health. So I think that's interesting, because if people had been paying more attention to history, they would have had a better understanding of what would follow. And that was a really big learning experience for me.
Yeah, I think the beauty of it is history, and you've touched on it there with Ferguson. And I think also the fact that we tend to not read enough. You and I read. I know you read loads, and Merrin as well. But I think a lot of investors don't read, or they haven't got the time, or they say they haven't got the time to read stuff. But I wanted to ask you this question, and it goes back to what you were saying just now, right? We often talk about capitulation of investors, where many hung on to hugely declining stocks, investments per se, right? They finally cave in and sell out, right? And you spoke in your book about the point of maximum revulsion. I've not heard it phrased like that before. Please, can you explain this, and why occasionally this can prove to be actually the point of great opportunity for the contrarian? Because I'm a contrarian, as you know.
Yeah, I mean, I think actually March 2020 is probably a good example of this, because unlike March 2009, I would say that was one of the most obvious big market capitulation points that I've seen. And the reason I say it's obvious is because I would say that almost everyone who was contributing to the magazine, all the fund managers that I spoke to at that point said, "Oh no, this is the bottom." And I thought that was very interesting. But yeah, capitulation is just the point where, so if you're an investor, and you'll recognize this, I'm sure most of the people listening will recognize this. So you hold on to something and then it goes down a bit and you think, okay, well, it's not doing what I wanted it to, but I'm going to hold on because it'll come back. And then it goes down more, and then it goes down more, and then you're down about 60%, and you think, oh my, I need to get out. I need to get
been there many times, yes.
Yeah, exactly. And then of course you get out, and that is the bottom. And the point is because collectively everyone who's going to sell has then sold. And then it's just, well, there is no more kind of selling pressure. I mean, obviously for individual stocks, there are plenty of stocks that go to zero, and you should get out when you're 60% down, because it's still better to have the money than lose it all. But in terms of things like actual global markets, the FTSE 100 is not going to go to zero. So there does always come a point where this is a buying opportunity, and it might even be quite an obvious buying opportunity. The other thing to watch, and I mean, we might get onto this, is definitely things like headlines and magazine covers. Those are good. Those, in my experience, those are good for sentiment, and getting a sense of, if you look at a kind of newspaper headline, especially with something like the Times that doesn't normally have a business headline on its front page, and if the tone is particularly hysterical, then you've got to the point where the vast majority of people are really worrying and really panicking. And if the vast majority of people are really panicking, that suggests that the panic has already been priced into the market. So you can't have that much further down to go. And you build, I mean, somebody, I can't remember the name, but it's in the book. A couple of analysts looked at Economist magazine covers, and found that when the Economist was very obviously bullish on a sector or a country, then it was probably a good time to sell, and vice versa. So if they were very aggressively bearish on something, then that probably marked that the time was near the bottom. And it's not because, writers for The Economist or whatever aren't clever. They are. I mean, they're kind of loads of Oxbridge graduates, etc. It's just because it's a mass market magazine, so it's got, the circulation is in the millions. So the point is, if they know about it, then everyone must know about it. So, and markets are all about expectations. I think that's the one thing that if I could teach or hammer through to people's heads, markets are about expectations. So it doesn't matter if Britain's facing a recession, if everybody already knows it. It's like, it's going to be in the price. What really matters is then a surprise either way, because that's what will move the market. And I think that is a core thing that people often don't understand, because people say to me, "Oh, look, but we just found out that the second quarter GDP kind of was shrunk." And I'm like, well, yeah, but the market doesn't care, because the market knew about that while it was happening. It's like the market is now thinking about what's going to happen in Q2 next year. So I think that's always an interesting element of the way that people kind of misunderstand markets, I think.
Yeah, I mean, one of the famous magazines for doing that is, or being quoted a lot, as Forbes, and they always reference Forbes to say, "Oh, that's peak. Let's go in the opposite direction now."
Yeah.
So that does run seamlessly to my next question. We had the likes of GameStop, Theranos, with the lady, forget her first name again, Holmes, and NFTs. How using media, because you mentioned it and you reference it in your book quite a lot. How do we as individual private investors spot, or would be better to learn how to spot bubbles? What's your thoughts there, John?
I mean, bubbles are fascinating, actually, and they are tricky in that I don't recommend that people try to time bubbles, as in getting out at the top or that sort of thing. It's just good to be aware of them. I mean, Theranos is an interesting one, because obviously, I mean, nobody would have invested in Theranos outside a kind of, venture capitalist. But she was on the cover of, I think it was Forbes or Fortune magazine.
Every
magazine, yeah. And it's, with this miracle kind of like blood test. And I think it was that within a couple of months of that it turned out that it was all made up, basically. And, the revelations all came out. I mean, this is a classic one, Time just did Elon Musk as their man of the year on the front cover. And of course, that's around about the time that Tesla kind of, and actually the wider, what I call kind of jam tomorrow bubble actually started to pop. Cathy Woods is another good example. Cathy has this exchange traded fund called the ARC Innovation ETF, and it invests in all the most speculative stocks out there. And people were sort of comparing her to Berkshire Hathaway. Her fund had like rocketed because it was, invested in all this speculative stuff. And then, of course, February 2021, I'm sure there was a big profile on her in the FT, and that marked a peak. That's when kind of ARC, hit the top. And actually now, since 2014, which is when it was launched, Berkshire Hathaway is now outperforming it again, which is a really useful lesson in taking the long-term view.
Absolutely.
Yeah, aye. So it is. I think what to do. The other thing I would suggest to people actually about when they're reading things like the FT, if you get the physical paper, then again, like look at the back pages, because that's the stories that are kind of bubbling under, and they're the sort of areas where you kind of find possibly ideas for opportunities and themes that might be becoming more popular, as opposed to the front pages, because again, that's all the stuff that's already known and that's already in the price.
Obvious.
Yeah. So read your paper back to front, basically.
Yeah, no, that's a good tip. I mean, I used to do that with the football. It's got straight to the back page. So we touched on a few names there. I won't reference them again, but it takes me seamlessly to my next question, John. Intellectual humility is recognized as a psychological trait, a good trait. Yeah. However, we've seen and recognized numerous occasions where hubris has been the undoing of many an investor and fund manager, politicians as well, and CEOs of listed companies. John, given your experience, what signs should we all look for or look out for with regards to individuals running companies, funds, etc., regarding their lack of intellectual humility, and therefore we should beware of putting our personal wealth at risk?
I mean, I think there's a lot of kind of different elements to that, but intellectual humility, to my mind, boils down to understanding your own limitations as an investor. So I think that the main thing I'd watch for in fund managers specifically is style drift, because what tends to happen is that a fund manager gets known, and actually there's two things. There's obviously this is a bigger risk for higher profile people, because the more adulation you're getting, the harder it is to be intellectually humble. And so what happens is that, say a fund manager, Neil Woodford is a good example here. Now, he became famous because he was arguably a contrarian income investor who basically made an awful lot of money by buying tobacco stocks when everyone else was shunning them, and by avoiding getting stuck in the tech bubble. So there was nothing wrong with that. I mean, I think that, you should be, he should be pleased and proud that that's what he did. But then he started getting into something completely different, which was kind of effectively a form of kind of venture capital, kind of private equity thing, where he's buying all these unlisted stocks and really, kind of slightly out there. I mean, almost like a kind of Cathy Wood type sort of like set of investments. And so that, I think, was a very obvious warning sign that, well, in what way does having spent 20 years successfully investing in FTSE 100, big, huge liquid stocks, qualify you to be extremely good at picking winners from tiny unlisted stocks? So that's style drift is definitely one good example. Similar with chief execs, though. Chief execs, acquisitions that don't make sense apart from for ego boosting. I do think that empire building is a big risk among CEOs. I mean, obviously they have slightly different drivers. Ego is a big issue, as we saw with the CEO of Royal Bank of Scotland, sort of with his own personal fiefdom in Edinburgh, essentially. But it's not just that. It's a desire to kind of grow through acquisition is generally not that great for shareholders anyway. But also they tend to do it at or near the top. It's amazing how much M&A activity appears closer to the top of the market rather than the bottom of the market when everything's cheap.
I've never understood that aspect of it, John.
I think it's just CEOs are human beings like the rest is, and they're really, they get sucked into the excitement, and they believe their own hype. So it's tricky. It really is difficult. I mean, I admire somebody like Jeff Bezos, who, for all of his, at the moment he's clearly just currently having fun, but he's always been a very good communicator. That's something I think investors should watch out for as a positive. If a CEO is very good at communicating a company's strategy, the chief executive of Next is a very good example of this over here.
I was going to say that's the example.
That's a really good sign because it shows that they are thinking clearly. They know who they're answerable to because they're communicating to all the people who matter, including the shareholders and the employees. So in a way, you can actually see it as a positive form of, because I'm very cynical about ESG and stakeholder capitalism and all that sort of stuff. But those people are communicating with their stakeholders and they're doing it clearly, which shows that they understand what they're talking about. So I think that's a very, and actually Warren Buffett is probably the number one example of this. But yeah, so that I think is a positive thing to look out for.
Brilliant. Thank you for that reply. I really appreciate that. I wanted to go a bit more into your book, if I may. You wrote in one of the paragraphs, and I must say, I must qualify this and say, I love your turn of phrase sometimes when you write something. I'm like, how did you throw that in there? Absolutely brilliant. You wrote here, the first cockroach is rarely the last. The archetypal profit warning. Then you coined Britney Spears. Oops, I did it again. Please, John, can you explain to our Investing Matters listeners and others as well why we should be vigilant of companies that announce a profit warning, as they often happen in ones or twos or maybe threes? Rarely happen in isolation, do they?
Yeah, well, I think the thing this boils down to psychology. So the market again is all about expectations. If you're a corporate chief exec, your earnings are tied to the share price almost all the time. So that's the thing you're most worried about. So you don't want to deliver any news that disappoints shareholders. And at the same time, your employees probably are aware of that, and they don't want to deliver news that's going to upset you. So the difficulty is that everyone's trying to manage someone else's expectations. So what happens is that a profit warning only comes about when there's no other option except to fess up. And that means that they're probably soft soaping the first one. And there's probably other stuff that's about to come out that everyone's been too scared to tell the chief exec. And that's why you find that they do tend to tumble out in kind of, twos and threes. It's not always like that. Sometimes a profit warning is very clearly the result of a one-off event or some contained event. And I think that if you can see the company is ahead of it, then that's fine. But most of the time, or at least a good chunk of the time, it's a kind of ongoing leak that hasn't been plugged, and now it's turned into, now the bath is overflowing and coming through, your kitchen roof, and the sort of, everyone's going, wait a minute. So yeah, I think you have to be very careful if a company issues a profit warning. And if you own the stock, you need. Oh, sorry, go.
I'm going to say, sometimes you see one of the directors going, then the CFO goes, and when the CEO goes, you're like, it's just gone completely pear-shaped now. Aye. It's that sort of sequence you see, don't you?
Yeah, and the CFO going is definitely a classic warning sign, because you're like, well, look, who knows what the numbers are then? if they're diving off the kind of boat, then That always makes me makes me worried.
Right. So I want to switch it up now because you've written loads on fund managers, and you've written in the book as well about how to find a good contrarian fund manager. And I want because I'm always a little bit, when I see fund managers and hedge funds, I always put them into the same sort of category, and it's tend to always go onto the same thing. If one person's in that area or that stock or that sector, they're all in it together. So it's very rare you can find a contrarian fund manager. So how do we go about identifying those?
Again, I think a lot of it is actually similar to what I was just saying about chief execs. I think if you can find a fund manager who can communicate their strategy very clearly and in a way that retail investors can understand, then that's a good sign. So that's your, for example, your Terry Smiths or your, Nick Trains of the world. Now, they obviously they have a very similar style, although they're not all in the same stocks. And I think the other thing you have to remember is that styles do go in and out of fashion. I don't think that if you're looking to invest with a fund manager rather than go passive, then the first thing you want to do is make sure they're not just tracking the index. So that's quite straightforward. You just look at the top 10 holdings, look at what they're saying about things and see if they've, if they're just copying the index or not. When it comes to the contrarian thing, I think you really need to find people who are taking either big bets, just doing something very different to what the wider market is doing. Because if you want to make money as a contrarian, if you want to beat the market, you have to do something different to what the wider market is doing. So that's the other thing. But I think that if you're looking for individual managers who are doing a good job of this, then that thing of being able to communicate their strategy very clearly to people is actually one of the number one things that I would look for. And again, it's a very rare skill to have. And I'm not sure why that is. I actually think it's mainly because there aren't that many people who do think with that level of clarity about what they're doing. I think an awful lot of people in most industries are just kind of winging it to an extent, which might more reflect on the industry that I'm in. I don't know.
No, that's a good point. Now, I'm going to give the shout out again for the book, the Skeptical Investor: How Contrarians Bet Against the Market and Win, and you can too. Now, my favorite section of the book, John, obviously, is where you because I spent endless amounts of hours trying to find the sum of parts and intrinsic value of a company so I can get it. I want £1 worth of value. I want to pay 50 pence or 60 pence for that. That's what I'm all about. So you wrote a brilliant chapter on it. And what I wanted to ask, therefore, is that chapter, Buying Companies for Less Than Their Worth. Please would you share with our listeners the key concepts as to what they should be looking for regarding the fundamentals of investing? Because I don't want everyone to spend 100 hours researching a stock. Just simplify it for us. How can they shortcut that?
Well, I think that the main thing is there's a lot of talk about value versus growth, particularly there has been over the last kind of wee while, and I think that you can really boil it down to something. It's quite. You really just want to. So the market's all about expectations, and so if and markets are often right. The reason we use them is because they're often right. So what you have to find basically is a company where you think that the market has, made a mistake on this, and then you have to think about, well, what's the market currently got priced in, and why do I think that the market is wrong about this company? And then you need to get your margin of safety, which is, well, what do I think the company's actually worth? Is that sufficiently larger than what the market says the company's currently worth for it to offer me enough kind of, room for maneuver if I turn out to be wrong, or if it takes longer for the market to wake up to this, intrinsic value that I believe that the stock has that it hasn't, put on it. And that's not easy to do. And I do think that I mean, one reason that I wrote The Skeptical Investor is to try and get across to investors how difficult it is to be an active investor and to beat the market. And just to kind of like give a sense of the idea of, that it's actually quite a lot of work if you're going to become an individual stock picker to actually do this. And so you do actually need to go away and do your homework. But in terms of the way they kind of, to approach it is that thing of, right, well, what's the market think? What do I think? Why is there a difference there? And is it a big enough difference that it's worth me, taking the risk of investing and, potentially getting it wrong?
The thing is, and you and I are in the same boat in the sense of we're almost sometimes as contrarians most of the times going down the unpopular route and viewpoint. So the element of psychology that you've studied and I've studied is the fact of we've got to enable ourselves to get in a position of being uncomfortable, in an unpopular sort of place, and also try and make it so that we can then maintain our own resilience to be patient. But that's a really hard thing to build. How would you say that an investor could build on their resilience to remain patient for longer?
Yeah, I mean, that is a tricky one. I think the main thing, and I'm slightly, there's always this tension between being somebody who writes about financial markets on a daily basis and the amount of time I think investors should spend actually paying attention to financial markets. And so I've all, I mean, I remember there's a few times I've sort of said, we should actually publish a monthly edition of MoneyWeek that's shorter, but we charge more for it, because that's the kind of, that's the kind of frequency or even less that people should be paying attention to the markets. But that's it. I mean, one way is to improve your resilience is simply not to make a decision, know why you've made that decision. It's really important before you invest in anything that you understand why you've done it, because then you can park it. Then you can leave it until you need to go back to it and say, right, well, has the story changed now? So I think that's really important. You have to kind of write down, look, here's why I've invested in this, and that'll help you kind of to maintain your patience, because you understand why you're doing it. The problem with not doing that and not being fully cognizant of why you've bought something is that it's very easy to then get your opinion changed simply by the fact that the stock's not going up, or simply by the fact that other people are saying, oh no, but you should be investing in this instead, or that stock's, it's really stupid to be in oil and gas just now because electric cars are going to take over the world. So it's that you need to cultivate the kind of strength of mind to kind of go your own way. And a big part of that is understanding your rationale for buying something in the first place.
Love that reply. Thank you ever so much. Now, I've got a final question to ask you, John, because obviously the markets have been hugely volatile. S&P 500, Dow Jones is flying up and down 3 or 4, 5% all over the shop. And the warning signs have been there now for a year, and the markets, UK and Europe as well, have been climbing a wall of worry. And we've seen the last 2 days of action, 900 points up on the Dow, 1,200 points or 1,100 points down yesterday. What advice can you give, or what sort of words of wisdom can you share with our investors and our listeners on this podcast as to how they can maintain some resolve regarding these volatile markets, and what they should actually consider doing to maintain long-term investing rather than going in and out of the market all the time?
Yeah, I mean, don't be a day trader, I would say, is really try and avoid doing that. I mean, I know some people can do it, but most of us can't. Avoid being leveraged. The one thing you do with volatile markets is make sure you've got enough cash. Because having cash is important for two reasons. One, it means you can use it because opportunities might come up for stocks that you like. But the other thing is that it gives you a mental cushion. This is the kind of markets that the people who are leveraged get margin called in, and stuff sells off for no reason at all other than the fact that people need to sell it to raise funds. So some of the most liquid, some of the best quality stuff out there gets sold off at times like these. And that's why you want to be the person with cash, so you can pick it up for less than, less than it's actually worth, really, is what it boils down to. So that's one thing. Can I hold probably a bit more cash than you normally would? The other thing is try not to pay too much attention to the big swings. One thing I think is really worth remembering is that massive up days and massive down days all happen generally in bear markets, and they also happen one after the other. So you can see the Dow going up 1,000 points and feel, oh, I should have been in there. It's like, well, no, look, this is just what happens at times like these. So please put that sort of thing out of your mind. You don't have to act at any point. Take a deep breath, step away from the terminal. It's, you don't have to do anything. And the other things, I mean, Mark actually said, Mark Dampier, you interviewed him, I listened to the podcast, and he did make the point that, this is an unusual time and things are changing. We're coming to the end, potentially, of what has been a 40-year downward trend in interest rates. That means that there are very few people still working in markets today that have not been in that environment for their entire working lives. So, there's a load of people who are going to panic regardless, because they're not going to have seen an environment of rising rates and rising inflation, and they won't know what to do. And that's why I think it's kind of probably a good time to be patient and to revisit your asset allocation, think about what you're hoping to get from your portfolio, because it's going to be challenging. And things that we haven't had to worry about for a very long time, like real returns, as in after inflation returns, are going to matter an awful lot more. I mean, the prevailing inflation rate since like 1997 has been, around about 2%, give or take, in the UK since that time. And now we're sitting at 7. The Bank of England saying it might go up to 10, and that's on the, the kind of slightly the CPI, which tends to be lower than RPI. So no, it's going to be a really challenging time. And I personally don't think inflation is going to go back to what we've seen over the last 10 years. And even if it sits at, 4%, 3% consistently for the next 5 years, that's a massively different environment to the one that we've all been used to. So yeah, I think patience and just trying not to have too much conviction in one asset class or outcome, because there's a lot of balls in there at the moment, basically.
No, I love that reply. I'm going to close it there, John, but we might have to speak again, I think. I don't think we've covered half the things that we could have covered today. I really appreciate what you've done. You're an absolutely phenomenal writer. You and your colleague, Marion, are absolutely awesome. And I want to thank you for this fantastic book
thanks,
that I've read
Peter.
from cover to cover. And I'm hoping you're going to do a part 2 at some point, because I think this book is needed for educational purposes. And I think everybody that arrives in your team should read this first before they start writing anything at all. And I want to send you some love from my good friend Phil Oakley as well, who I know that you've helped and supported in the past regarding his writing as well. So I want to thank you ever so much, and wish you all the very best with your family, and keep playing the guitar as well when you get some time off.
Thanks very much, Peter. I really enjoyed that. Really nice to meet you and talk to you.
And I'll hope to speak to you and meet you in person at some point as well, John. All right.
Definitely. Take care, man.
Take care. God bless.